Hi everyone, my name is Wayne, and you can call me Jennifer. Today our group will be presenting an analysis of Gemini electronic case. I will begin with an overview of the company and how it operates. Sarah will then walk us through the SWOT analysis and financial performance. Finally, Shantara will present our recommendations and key takeaways. Let's talk about company overviews, what Gemini does. Gemini Company is a US-based consumer electronic company focused on the mass market. Its core product is LCD televisions supported by DVD and Blu-rays, players, home theater system, and cable sets. Rather than competing on premium branding, Gemini positioned itself around value, offering reliable product at a more affordable price. Let's talk about where and why they manufacture. A key part of Gemini's business model is domestic manufacturing. Final assembly takes place in the United States, allowing the company to operate with a just-in-time production system. This keeps inventory low, improves responsiveness to retailer demand, and reduces logistics costs. And also talk about retailers and market position. Gemini distributes its products primarily through large retailers such as Best Buy, Costco, Walmart, and Target. Faster delivery and shorter supply chains reduce inventory risk for these retailers, which help Gemini grow quickly in the North American TV market. To talk about last part, industry and competition, Gemini competes in a highly competitive consumer electronics industry. Its main competitors include Samsung, Sony, and LG, which benefit from strong brand and advanced technology. As a new brand, Gemini initially faced challenges earning retailer consumer trust. Second, company stage and challenges. Although Gemini is no longer a startup, it remains younger than many of its competitors. Limited brand recognition led to flexible payment terms, which pressured cash flow but helped Gemini secure shelf space and long-term retail partnership. Overall, Gemini has a strong operational advantage through local manufacturing, but it also faces challenges from competition, pricing pressure, and technology gaps. Next, Sarah will walk us through the SWOT analysis and financial performance.
Hey everyone, I'm Sarah. I'm going to be taking you through the SWOT analysis and then get into the organizational financials. Starting with strengths, Gemini runs a really efficient operation with highly automated production. They use just-in-time manufacturing, which helps keep their inventory low and gets products to their retailers faster. Their operational margins are strong compared to the industry averages. They have significant cash reserves that give them the flexibility to grow. On top of that, they have a strong research and development or R&D team that's driving their innovation, which improves their access to capital from investors. That's always great for funding new projects. Moving on to weaknesses, the company does rely a lot on their debt financing. A lot of cash is tied up in accounts receivable or AR and in inventory. Most of the revenue still comes from TVs. So they're a bit overly dependent on one product line. They have limited negotiation power with the retailers as well because their brand isn't very well known yet, since they're still relatively new. The speed of innovation in the industry is a real challenge because they need to keep up with the changing technology, and it's very easy to be outpaced in the tech world right now. Let's talk about opportunities. There's a few clear ones. Gemini could expand into smart TVs and 3D TVs. Of course, this is keeping in line with their one main product. They could also grow through selective acquisitions, and by that I mean they'd be buying smaller companies that complement their current products. The idea basically is to be strategic and pick acquisitions that fit well with what Gemini already does. They could also gradually expand geographically as they strengthen their relationships with their retailers. There's a few other ways to grow as well, expanding complementary product lines like maybe sound bars or home theater systems. Connectivity, accessories, and other items could bring in more revenue without moving too far from their core products that they already create. Using e-commerce or direct-to-consumer channels would open up new markets and improve their margins because they'd be going directly to the consumer instead of the middleman with the retailer. Another option could also be partnering with another U.S. company, U.S.-based company or U.S. manufacturer or whatever, to help avoid tariffs, and that's a big issue everyone's dealing with right now. A lot of the bigger competitors are having to deal with that, and that can help keep their costs down also while they're expanding. Finally, let's go over the threat section of the SWOT analysis. The industry is very competitive, so price competition is always a risk. Technology changes quickly, which means products become outdated really quickly and puts pressure on the R&D team. Retailers have a lot of bargaining power, again, because the brand name's not very well recognized yet, which can affect the company's cash flow, and ongoing price competition can squeeze their margins. Gemini does most of its manufacturing in the US, but they do still source some of their components from other countries, so tariffs and trade policy changes remain a risk that could increase their costs. Let's see. Now that we've gone through the SWOT analysis, let's look at the financial health of Gemini. I'm going to cover liquidity, asset management, long-term debt, and profitability, and what those numbers mean for the company's potential growth. Liquidity ratios show whether a company can cover their short-term obligations. Gemini's current and quick ratios do indicate they have enough working capital for immediate needs. That's important because as they grow, they'll need cash for production, new product launches, potential acquisitions, and so on. Healthy liquidity also gives them the flexibility to respond to supply chain disruptions responsibly, especially since some components are coming from outside of the US. Moving on to asset management, ratios like inventory turnover, receivables turnover, they show how well Gemini uses resources to generate their revenue. The numbers suggest inventory and receivables are managed efficiently, although some cash is tied up due to generous credit terms with the retailers. Again, that goes back to how well their brand is known. This is expected for a company that's in this early growth phase. Efficient asset use is key if they want to scale globally because it's going to let them generate revenue without locking up too much capital, and it helps them reduce waste. Debt ratios like debt to equity measure the ability to manage long-term obligations. Gemini relies on financing more than the industry average, but they generate enough operating income to comfortably cover their interest payments. As they expand, whether they do that through new products, acquisitions, entering new markets, whatever, they'll need to balance the debt and retain earnings very carefully. Taking on too much risk could be very dangerous, especially if tariffs or global market conditions change. Profitability ratios like net profit margin, return on assets, return on equity show that Gemini has performed well historically with strong margins due to efficient operations and scale. However, margins have started to decline recently because of price competition and the cost of growth initiatives. Profitability is still critical because it funds R&D, product innovations, sustainable growth, whether that's acquisitions or anything else. And by continuing to innovate in TVs and home entertainment while keeping production efficient, Gemini can stay competitive globally without cutting corners. Overall, Gemini's financial ratio shows that the company is in a solid position to grow. There are risks to watch, especially around the debt levels and cash tied up in receivables. So paying attention to efficiency, profitability, and liquidity is going to be critical as they expand product lines, maybe enter new markets, or pursue strategic acquisitions. Next, Shantara is going to go over our recommendations for Gemini.
Thank you, Sarah. I am Shantara Kirkwood, and I'm going to provide recommendations and then follow through with our conclusion. And for Gemini, our recommendations, we want to see some impact on the financials. We are seeking for them to reduce their debt. And many may be asking within this market and looking at their cash flows and cash on hand, how do we really want to do that? Well, we're looking to kind of leverage what they've already done with their IPO and increase the opportunity for additional stock sales. And then once that money is earned, then go back in and reduce the debt payments or pay off the debts to reduce those payments. We could also look at this from an opportunity for Gemini to refinance some of their debts to lower interest rates. We also want to offer a recommendation for Gemini to increase their marketing and focus on American made as a key standard. During this time period of their growth, we see what we call a lot of backshoring, where many businesses are trying to come back to the U.S. to help promote job opportunities and also to reduce costs related from the imports of different components and tariffs. So in that market expansion, we want them to tout that they are an American-made business and that they promote jobs. And we want to also give them that opportunity to expand their footprint within the U.S., their sales footprint. And we want to do this not only by just kind of moving product over to them, but ensuring that we have that market. So go out and doing that test to kind of see where the landscape of the community lies. How do they view Gemini? Do they even know about Gemini? And in doing that survey, then we can kind of push our marketing to promote, like I said, American made to consumers so that they can come out and purchase the product. We also want to take this opportunity to increase our partnerships, right? And so Bose was one of the companies that was noted in our case study. Bose is known for their sound enhancements. So during this time, Gemini is going into the home audio, home studio sales business. And we want to make sure that they have a good, robust product behind them. Bose is a well-known brand. They are looking for a partnership, acquisition, and we believe Gemini would be the right partner for this. We also want to talk about domestic component parts. We want to seek out domestic suppliers for the components that Gemini needs for their televisions to move faster and quicker with the growing segment of technology. And so in doing this and having that home-based component supplier, they can then partner with the R&D team at Gemini so that they can produce a product that is more stellar and that's not come across from overseas and does not bear the burden of the additional tariffs. So that's what we want to do for our recommendations. Enhance the financing by reducing debt, expand the marketing to reflect American made and grow our footprint within America, and then establish those additional partnerships through Bose and their home theater offerings for sound quality of our televisions and our domestic partners that can produce chips.